The age of easy money. How central banks printed $25 trillion and broke capitalism. On March 15th, 2020, Jerome Powell, the chairman of the Federal Reserve, the most powerful central bank in the world, made a decision that would change everything about how money works, how markets function, and how an entire generation thinks about investing and wealth. In an emergency Sunday evening announcement, as the COVID pandemic was spreading across America and markets were in free fall, Powell announced that the Federal Reserve would cut interest rates to zero, would begin purchasing unlimited amounts of government bonds and mortgage-backed securities, and would do whatever it takes to support the economy and financial markets. Within weeks, the Fed had injected trillions of dollars into the financial system, and they weren't alone. Central banks around the world, the European Central Bank, the Bank of Japan, the Bank of England, they all did the same thing, printing money on a scale never seen in human history. And what happened next was the most spectacular financial bubble in modern times. Everything went up. Stocks, bonds, real estate, cryptocurrency, art, collectibles, meme stocks, NFTs. Companies with no revenue were worth billions. Teenagers were making millions day trading from their bedrooms. Real estate prices doubled in 2 years. Bitcoin went from $5,000 to $69,000, and millions of people who had been told their whole lives that building wealth required hard work and patience, and saving suddenly discovered that the fastest way to get rich was to borrow money at near zero interest rates and buy literally anything because everything only went up. But here's what makes this story absolutely critical to understand. This wasn't the first time central banks had done this. It was the culmination of a 15-year experiment in monetary policy that started with the 2008 financial crisis, an experiment that broke fundamental rules about how money and markets are supposed to work, an experiment that created such massive distortions in asset prices and risk perception that when it finally ended in 2022, when inflation forced central banks to raise interest rates and stop printing money, everything that had gone up came crashing down, wiping out trillions in wealth, destroying companies that had seemed invincible, bankrupting investors who thought they had discovered the secret to easy money, and leaving an entire generation wondering if they'll ever be able to afford a house or retire comfortably, because the age of easy money inflated asset prices so much that normal people got priced out of the American dream. This isn't a story about one fraud or one company. This is a story about how the entire financial system became addicted to cheap money, how central banks created moral hazard on a global scale, and how we're all still living with the consequences of the greatest monetary experiment in human history. An experiment that might have saved us from a Great Depression in 2008 and 2020, but that also created inequality, instability, and a generation of investors who learned all the wrong lessons about how markets work. Let me take you back to 2008, because that's where this story really begins. Before the financial crisis, central banking was relatively simple and constrained. The Federal Reserve's main job was to manage inflation and employment by adjusting interest rates. When the economy was too hot and inflation was rising, they raised rates to slow things down. When the economy was too cold and unemployment was high, they lowered rates to stimulate growth. And they had a target interest rate around 4 to 5% in normal times, which gave them room to cut rates when needed. This was the traditional playbook tested over decades, and it generally worked. But in 2008, when the housing bubble collapsed and the financial system nearly imploded, when Lehman Brothers failed and banks stopped lending to each other and credit markets froze, the Fed cut interest rates to zero, and it wasn't enough. The economy was still collapsing. Unemployment was skyrocketing, and zero interest rates couldn't fix it because the problem wasn't the cost of borrowing. It was that nobody wanted to lend or borrow at all. Banks were terrified of failing. Businesses were terrified of going bankrupt. Consumers were terrified of losing their jobs. And the entire system was seized up with fear. So Ben Bernanke, who was Fed chairman at the time and was an academic expert on the Great Depression, decided to try something unprecedented. Something that had been discussed in theory, but never attempted at this scale in modern times. The Fed would directly purchase massive amounts of government bonds and mortgage-backed securities, injecting money into the financial system, not by lowering interest rates, but by literally creating new money and using it to buy assets. This policy was called quantitative easing, or QE, and it was supposed to be temporary. An emergency measure to prevent a complete economic collapse. The theory was that by buying bonds, the Fed would lower long-term interest rates, make borrowing cheaper, support asset prices, encourage lending, and stimulate the economy. And then, once the crisis was over, they would reverse the process, sell the bonds back, remove the money from the system, and return to normal monetary policy. The first round of QE, QE1 as it became known, involved the Fed purchasing about $1.7 trillion in assets between 2008 and 2010. And it worked, sort of. The economy stopped collapsing. Markets stabilized. The banking system survived. Unemployment eventually began to fall. But the recovery was slow and painful, much slower than anyone wanted. And so the Fed did it again. QE2 in 2010 to 2011, another $600 billion, and then QE3 from 2012 to 2014, another $1.7 trillion. And by the end of QE3, the Fed's balance sheet, which had been under $1 trillion before the crisis, had exploded to over $4.5 trillion. They had created trillions of dollars out of thin air and used it to buy bonds. And that money was now in the financial system, held by banks and investors who had sold bonds to the Fed. And something strange started happening, something that would define the next decade and create the conditions for everything that followed. With so much money sloshing around in the financial system and with interest rates at zero, investors were desperate for returns. You couldn't make money on savings accounts or government bonds anymore. Those paid basically nothing. So investors had to take more risk, had to buy stocks, had to buy corporate bonds, had to buy real estate, had to buy anything that offered some kind of return. And this created a massive flow of money into risk assets, driving up prices. And as prices went up, more investors piled in, not wanting to miss out, creating this feedback loop where easy money from central banks flowed into assets, driving prices higher, which attracted more money, which drove prices even higher. The stock market recovered from the 2008 crisis and then just kept going up year after year with only minor pullbacks. The S&P 500 tripled between 2009 and 2019, not because corporate earnings were growing that fast, but because central bank money was flooding into stocks, because investors had no other place to put their money where they could get a decent return. Because the Fed had essentially put a floor under the market. Investors started calling it the Fed put. The idea that if markets ever fell significantly, the Fed would intervene with more stimulus, more QE, more support. And so taking risk became less risky because the Fed had your back. This created moral hazard at an institutional scale. Moral hazard is when someone is protected from the consequences of their risky behavior, and so they take even more risk. Like if you had fire insurance that paid you more than your house was worth, you might not be as careful about fire safety. And what the Fed had done, perhaps unintentionally, was create insurance for financial markets. They had shown that when things got bad, they would intervene, they would support asset prices, they would do whatever it took to prevent markets from falling too far. And so investors started taking bigger and bigger risks, buying overvalued assets, using more leverage, making bets that only made sense if you assumed the Fed would always be there to save you if things went wrong. And it wasn't just the Fed. The European Central Bank started its own QE program in 2015, eventually buying over 2.6 trillion in assets. The Bank of Japan had been doing QE since the early 2000s and ramped it up dramatically, at one point owning over 40% of all Japanese government bonds. Central banks around the world were all doing the same thing, printing money, buying bonds, keeping interest rates at zero or even negative, creating this global ocean of easy money that had to flow somewhere, and it flowed into everything. Real estate prices in major cities exploded, not because people's incomes were growing or because there was a sudden increase in demand for housing, but because investors with access to cheap money were buying property as an investment, because wealthy individuals and institutions were parking their money in real estate because it paid better returns than bonds, because foreign investors were moving money into safe haven cities like New York and London and Vancouver, and this priced normal people out of home ownership in many markets, created homelessness crises in major cities, and fundamentally changed the nature of housing from something people lived in to something people invested in. But central banks didn't care about that or claimed they couldn't do anything about it. Their mandate was inflation and employment, not housing affordability. And by their measures, everything was fine. Inflation was low, unemployment eventually fell to historic lows. The economy was growing, the fact that asset prices were exploding, and inequality was increasing. That wasn't their problem, or so they claimed. The corporate world changed dramatically during the age of easy money. With borrowing so cheap, companies could issue bonds at incredibly low interest rates and use that money not to invest in growth or innovation, but to buy back their own stock, boosting earnings per share and CEO compensation without actually improving the underlying business. Between 2010 and 2020, S&P 500 companies spent over $5 trillion on stock buybacks, money that could have gone to workers or research or capital investment, but instead went to boosting stock prices and enriching executives and shareholders. And this was rational behavior given the incentives. If you're a CEO and you can borrow money at 2% and use it to buy back stock, boosting your stock price and your stock options, why wouldn't you? The fact that this created fragility, that companies were loading up on debt and would be vulnerable if interest rates ever rose or if revenue ever fell, that was a problem for the future. And in the age of easy money, nobody worried about the future because the future would obviously be fine. The Fed would make sure of it. The startup and tech world became absolutely distorted by easy money. Venture capital firms raised massive funds because their limited partners, pension funds and university endowments and wealthy individuals had money burning a hole in their pocket and nowhere else to put it where they could get decent returns. And these VC firms poured money into startups at valuations that made no sense. Companies with no path to profitability were worth billions. Companies that were just burning cash to grow revenue with no concern for unit economics were celebrated as disruptors. WeWork was valued at $47 billion despite being a real estate company, pretending to be a tech company, and losing money on every lease. Uber and Lyft went public despite never having made a profit and having no clear path to profitability. And investors didn't care. They bought the shares anyway. Because in the age of easy money, profitability was quaint. Growth was everything. Disruption was everything. And besides, interest rates were zero. So why not take a chance on a company that might revolutionize transportation or co-working or whatever? The opportunity cost of capital was zero, so even risky bets made sense. And then COVID happened. And instead of being the moment when the age of easy money ended, when sanity returned to markets, when asset prices corrected to reflect reality, it became the moment when the age of easy money went into hyperdrive, went absolutely insane, became a parody of itself that would have seemed unbelievable if you had described it in advance. When COVID hit in March 2020 and the economy shut down and markets crashed, losing 30% in a matter of weeks, the Fed didn't just respond. They responded with overwhelming force. They cut rates to zero. They launched unlimited QE, buying not just government bonds, but corporate bonds, buying ETFs, essentially promising to buy whatever it took to support markets. And Congress passed massive stimulus bills, sending checks directly to people, expanding unemployment benefits, giving forgivable loans to businesses. Between the Fed and Congress, over $5 trillion was injected into the economy in a matter of months. And this money didn't just stabilize things, it created the most spectacular asset bubble in modern history. Stocks didn't just recover from the March 2020 crash, they exploded. The S&P 500 went up 68% between March 2020 and December 2021. The Nasdaq went up over 100%. And it wasn't just traditional tech companies. It was everything. Electric vehicle companies that had never made a car were worth more than Ford and GM combined. Rivian IPO'd at a valuation of $100 billion, having delivered almost no vehicles. Companies that were losing billions of dollars a year had stock prices that only went up because retail investors, sitting at home during lockdowns with stimulus checks and nothing to do, discovered day trading, discovered options, discovered that they could make more money trading meme stocks than they could at their jobs. And they piled into GameStop and AMC and whatever stock was trending on Reddit, and these stocks went up 1,000%, 2000%, not because of any fundamental value, but because retail traders were coordinating short squeezes and gamma squeezes and buying purely on momentum, and somehow it worked until it didn't. Cryptocurrency went absolutely parabolic. Bitcoin went from $5,000 in March 2020 to $69,000 in November 2021. Ethereum went from $100 to $4,800. And it wasn't just Bitcoin and Ethereum. Thousands of new cryptocurrencies were created, many of them total scams, and people bought them anyway because everything was going up. Because you'd be stupid not to buy crypto when it was clearly going to the moon. Teenagers were becoming millionaires buying Dogecoin, a cryptocurrency that started as a joke. People were taking out second mortgages to buy crypto, quitting their jobs to trade full-time, and the crypto industry that had been niche and weird suddenly became mainstream. Major institutions were investing. Companies were putting Bitcoin on their balance sheets. Crypto ads ran during the Super Bowl, and anyone who suggested this might be a bubble, that assets can't just go up forever, was dismissed as a dinosaur who didn't understand the new paradigm. NFTs, non-fungible tokens, became a thing. People were spending millions of dollars on JPEGs of cartoon apes, arguing that they were buying into communities and culture and the future of digital ownership. A digital artist named Beeple sold an NFT artwork for $69 million. Twitter founder Jack Dorsey sold an NFT of his first tweet for $2.9 million. And suddenly everyone was minting NFTs, creating digital art, buying virtual real estate in metaverses that didn't really exist. And while there was some genuine innovation and interesting ideas in the NFT space, Most of it was pure speculation, people buying JPEGs not because they liked the art, but because they thought they could sell it for more later. And the prices were set not by aesthetic value or cultural significance, but by how much money was sloshing around looking for the next thing to pump. Real estate went absolutely insane. Housing prices increased 40% nationally between 2020 and 2022. In some markets, they doubled, and this wasn't because of increased construction or growing populations. It was because interest rates were at record lows, because people were working from home and wanted more space, because investors were buying houses as rental properties or just as investments, and because there was so much money in the system that it had to go somewhere. Bidding wars became normal. Houses sold for hundreds of thousands over asking price. People waived inspections, waived contingencies, did whatever it took to win the bidding war. And millions of people, especially younger people, were completely priced out of homeownership, watching as houses that might have been affordable a few years earlier became impossible to buy. And this created a generation of renters, not by choice, but because the age of easy money had inflated asset prices beyond what normal incomes could support. SPACs, special purpose acquisition companies, became a craze. These were blank check companies that raised money through IPOs with no business, just a promise to find a company to merge with later, and investors bought them anyway. Hundreds of SPACs launched, raising tens of billions of dollars, merging with companies that had no business going public, companies with questionable business models. Sometimes with outright fraud. Nikola Motor went public via SPAC, claiming to have revolutionary electric truck technology. Their founder, Trevor Milton, was later convicted of fraud for lying about the technology. Their famous video of a truck driving was actually just a truck rolling downhill with no power. But in the age of easy money, nobody cared about due diligence. Nobody cared about fundamentals. The stock went up anyway. Until it didn't. Meme stocks became a phenomenon. Retail traders organizing on Reddit and other platforms to buy heavily shorted stocks, driving prices up and squeezing short sellers. GameStop was the most famous, going from $5 a share to nearly $500 in a matter of weeks in January 2021. And while some people made fortunes, many more lost everything when the inevitable crash came. But the lesson people took wasn't, be careful with speculation. It was, the game is rigged, but we can beat them if we work together. And this populist energy, this sense that Wall Street was the enemy and retail traders were the heroes, became part of the narrative of the age of easy money. The sense that normal people could get rich too. That you didn't need to be a hedge fund manager or have an MBA. You just needed to buy and hold and believe, and diamond hands became a virtue, and anyone who sold was a paper-handed trader. And this cult-like mentality around holding stocks regardless of fundamentals or price became dangerous when the money stopped being easy. And underpinning all of this, justifying all of this, was a narrative that became almost religious in its intensity. The narrative that we were in a new paradigm, that old rules about valuation and profitability and risk didn't apply anymore, that technology was changing everything so fast that traditional metrics were obsolete, that central banks had figured out how to manage the economy perfectly, so recessions were a thing of the past, that inflation was dead and would never come back, and therefore interest rates would stay at zero forever. And if interest rates were going to be zero forever, then paying high multiples for stocks made sense. Then losing money to gain market share made sense. Then everything being expensive made sense. Because how do you value a company when the discount rate is zero? You can justify almost any valuation if you assume interest rates will be zero forever and growth will continue indefinitely. And that's exactly what people did. They convinced themselves that this time really was different, that the age of easy money would last forever, that the Federal Reserve and other central banks had achieved some kind of perpetual motion machine where they could print unlimited money without consequences, where asset prices could just keep going up forever, supported by central bank purchases and stimulus, and the collective belief that number go up. But of course, it wasn't different. It was never different. The laws of economics didn't stop applying just because central banks were printing money, and the consequence that everyone had forgotten about, that central bankers had convinced themselves they had conquered, came roaring back in 2021 and 2022. Inflation. Prices started rising, first in commodities, then in goods, then in services, then in everything. Supply chain problems from COVID contributed. The war in Ukraine contributed. But the fundamental cause was too much money, chasing too few goods. Exactly what economic theory predicts will happen when you print trillions of dollars and hand it out to people. And by 2022, inflation was running at 9%, the highest in 40 years, and suddenly everything changed. The Federal Reserve, which had spent years saying inflation was transitory, that it was no big deal, that they would keep interest rates low and keep supporting the economy, suddenly pivoted, announced they were going to raise interest rates aggressively, were going to stop QE, and actually start reducing their balance sheet, selling bonds, removing money from the system, doing quantitative tightening. And this was the moment when the age of easy money ended, when reality reasserted itself, when everyone who had gotten rich or thought they were getting rich on cheap money suddenly discovered that when money stops being cheap, asset prices fall. And they fall hard. The stock market peaked in January 2022 and then fell 25%. The NASDAQ fell nearly 40%. Crypto crashed even harder. Bitcoin fell from $69,000 to $15,000. Ethereum fell 75%. Thousands of cryptocurrencies went to zero. NFTs became worthless. Those million-dollar JPEGs couldn't find buyers at any price. The metaverse real estate that people had spent millions on turned out to be worthless pixels. Growth stocks got destroyed. Unprofitable tech companies lost 80%, 90% of their value. Companies that had seemed invincible during the age of easy money were suddenly laying off employees and fighting for survival. Real estate stopped going up. In some markets, it started falling. And suddenly, people who had bought at the peak with 3% mortgages were underwater, owed more than their houses were worth, and people who had been counting on selling their houses for a profit to fund their retirement or their kids' college were stuck. SPACs crashed. Many of the companies that went public via SPAC are now trading at a fraction of their merger price. Some have gone bankrupt. Meme stocks crashed. GameStop is trading at a fraction of its peak. And all those diamond hands who held through the crash are sitting on massive losses. The retail traders who quit their jobs to day trade full-time are back at work or unemployed and trying to figure out what went wrong. And what went wrong was simple. They learned to invest during the most distorted market environment in history, during a time when everything went up regardless of fundamentals. And they thought that was normal, thought that was how markets work. And now they're learning the hard lesson that markets can go down. And when they go down, they can go down hard and fast, and your diamond hands won't save you. Companies that were worth billions during the age of easy money have collapsed. Carvana, which was going to revolutionize car buying, fell 98% from its peak. Its bonds were trading at 20 cents on the dollar. Peloton, which was worth $50 billion at its peak, fell to under $2 billion, laid off thousands of employees. Zoom, which seemed like it would dominate remote work forever, fell 90% from its peak. And these aren't scam companies. These are real businesses with real revenue, but they were valued for a world of zero interest rates and unlimited growth. And when that world ended, their valuations collapsed to reflect a more normal reality, and the venture capital-funded startups that raised money at insane valuations during 2020 and 2021, many of them are now doing down rounds, raising money at lower valuations than before, admitting that the valuations they got during the bubble were fictional, or they're going bankrupt, unable to raise more money, unable to survive without access to cheap capital. The crypto industry has been particularly devastated. Beyond just the price crashes, the industry built during the age of easy money turned out to be riddled with fraud and incompetence. Three Arrows Capital, a major crypto hedge fund, collapsed. Celsius Network froze customer funds and went bankrupt. Voyager Digital went bankrupt. BlockFi went bankrupt. Terra Luna collapsed, wiping out $40 billion. FTX collapsed spectacularly, turned out to be a massive fraud. Sam Bankman-Fried is in prison, and each of these failures triggered contagion, triggered more failures, revealed that much of the crypto industry was built on leverage and lies, and that when the easy money stopped, when people couldn't just assume prices would go up forever, the house of cards collapsed, and the victims, the people who lost money in these collapses, they were regular people, not sophisticated investors, people who had been told crypto was the future, who had been told to buy and hold, who had been told not to trust traditional finance, but to trust these crypto companies instead. And they learned the hard way that the crypto industry had all the same problems as traditional finance: fraud, leverage, excessive risk-taking, except without the regulations and protections that traditional finance has. The psychological and social impact of the age of easy money and its ending cannot be overstated. An entire generation came of age financially during a time when making money seemed easy, when every asset went up, when you could get rich quick if you just bought whatever was trending on social media. And they internalized the lesson that wealth comes easily, that you don't need to save patiently, that you don't need to invest in boring, diversified portfolios. You just need to find the next GameStop or Bitcoin or NFT project and go all in. YOLO. And many of them made money for a while, which reinforced the lesson, made them more confident, more willing to take risks, more convinced they had figured out some secret that older generations didn't understand. And then they lost it all, or most of it, when the bubble popped, and now they're bitter and confused and angry, feeling like they were cheated, like the game was rigged against them. And in a way, they're right. The game was rigged, but it was rigged in their favor for a while. Rigged by central banks printing trillions of dollars. And when the rigging stopped, reality caught up. The inequality created by the age of easy money is staggering and will have political consequences for decades. The people who benefited most from easy money were the people who already had assets, who owned stocks in real estate and businesses, because those asset prices exploded. Someone who owned a house in 2010 saw it double or triple in value by 2022. Someone who owned stocks saw their portfolio increase several times over, but someone who was young, who was just entering the workforce, who didn't own assets yet, they saw prices rise beyond their reach, saw homeownership become impossible, saw retirement seem like a distant fantasy, and this created a generation gap in wealth that's unprecedented. Millennials and Gen Z are significantly less wealthy than their parents were at the same age. Not because they're lazy or bad with money, but because the age of easy money inflated asset prices so much that normal income can't keep up. You can't save your way to a down payment when houses are appreciating faster than you can save. You can't build retirement savings when stock valuations are at historic highs, and expected future returns are therefore low. The political consequences are already visible. There's growing anger at central banks, at the Federal Reserve. Accusations that they created inflation, that they enriched the wealthy at the expense of everyone else, that they enabled speculation and fraud and bubbles. And much of this anger is justified. The Fed did create moral hazard, did inflate asset prices, did contribute to inequality, but they were also trying to prevent economic collapse, trying to avoid a repeat of the Great Depression, trying to manage impossible situations with imperfect tools. And the truth is that nobody knows what the right answer was. Maybe QE was necessary in 2008 and 2020 to prevent catastrophe, but maybe it went on too long. Maybe the Fed should have raised rates sooner, should have stopped QE sooner, should have prevented the bubble from getting so big. But they didn't, because raising rates is painful, causes unemployment, causes recessions. And central banks are always under political pressure to keep the party going, to support asset prices, to make people feel wealthy, even if that wealth is paper thin and built on debt. And now we're living with the consequences. Interest rates are high, inflation is slowly coming down, but prices remain elevated. Housing is still unaffordable for most people. The stock market is volatile and uncertain. Crypto has been exposed as mostly speculation and fraud. NFTs are a punchline. And an entire generation has learned that the easy money wasn't really easy. It was borrowed from the future, and now the bill is coming due. The age of easy money lasted from 2008 to 2022. 14 years of central bank intervention, of money printing, of zero interest rates, of moral hazard and asset bubbles, and increasing inequality, and it probably prevented two Great Depressions in 2008 and 2020, but it also created massive distortions, broke price discovery in markets, taught people that risk doesn't matter because central banks will always save you. And now that it's over, we're discovering that the rules of economics still apply, that you can't print your way to prosperity, that asset bubbles always pop, that leverage amplifies both gains and losses, and that when something seems too good to be true, it usually is. The lessons from the age of easy money are simple but profound. First, there's no such thing as a free lunch. The money central banks printed had to come from somewhere, and it came in the form of inflation and asset bubbles and distorted incentives. Second, asset prices do matter. Even if central banks claim they only care about consumer price inflation, when asset prices get too high, it creates inequality, instability, and eventual crashes that hurt everyone. Third, moral hazard is real and dangerous. When investors believe they'll be bailed out, they take excessive risks, and those risks eventually blow up and cause systemic problems. Fourth, you can't fight economics forever. Interest rates can't stay at zero forever. Asset prices can't rise forever. Eventually, fundamentals matter. And when reality reasserts itself, it does so painfully and suddenly. Fifth, and perhaps most importantly, understand the environment you're investing in. The people who got rich quick in 2020 and 2021 weren't geniuses. They were lucky to be investing during the most distorted market environment in history. And the strategies that worked then, buying unprofitable growth stocks, YOLOing into meme stocks, buying crypto, flipping NFTs, those strategies don't work in normal environments. They only work because central banks had flooded the system with money and driven interest rates to zero, creating a search for yield that pushed money into increasingly risky assets. And when that environment changed, those strategies stopped working. And the people who thought they had figured out the secret to easy money discovered they had just been riding a wave created by monetary policy. And when the wave ended, they crashed. So the next time central banks start printing money, the next time interest rates go to zero, the next time everyone around you seems to be getting rich effortlessly, remember the age of easy money? Remember that it felt permanent but wasn't. Remember that asset prices that rise on central bank money can fall just as quickly when that money stops flowing. Remember that the most dangerous phrase in investing is "this time is different," because it's never different. The fundamentals always matter eventually, and the easy money always stops being easy when reality catches up. The age of easy money is over, at least for now. And we're all dealing with the hangover, with inflation and high interest rates and crashed portfolios and unaffordable housing and the knowledge that the last 14 years weren't normal, weren't sustainable, and won't be repeated anytime soon. And maybe that's okay. Maybe normal is better than a bubble, even if normal is harder and slower and less exciting, because at least in normal markets, prices mean something. Risk means something, and building wealth requires actual value creation rather than just riding a wave of printed money, hoping you can get out before it crashes. And that might be a harder way to build wealth, but it's also more honest, more stable, and ultimately more sustainable than the age of easy money ever was.